Good afternoon, ladies and gentlemen. It's a pleasure to have you with Bernard. We are going to spend 1 hour with you trying to assess the consequences of this war in Ukraine. So during the presentation and afterwards, you can ask any question you want in any language, or which means French or English, by the way, not any other language. And we'll start with Bernard. Bernard will give you an assessment of the situation for different commodities, of the problems arising, with the possible exclusion of Russia from the world economy. And then I'll continue and I'll try to assess the macroeconomic effects of all of this and also what it means for central banks and for the capital markets. And we will do about 20 minutes each, and then will be yours for any question you may have, and we'll answer directly your questions. So Bernard, perhaps you can start to give us where we stand for all these commodity prices.
Thank you, Patrick. So yeah, very interesting times. I think the first thing to do is probably to contextualize the current market, just talking about what was happening just before the Russia-Ukraine crisis, because even before the Russia-Ukraine crisis, the commodities market was extremely high. I mean, be it energy, sorry.
Closer.
Yeah. So yeah, as I was saying, to contextualize, is that the commodities market was already close to record highs in a lot of areas. And part of the reason why was essentially the bumper effect that we were going through in 2021. And that bumper effect was mainly thanks to because of the lockdown that took place in 2020, you got that surge in demand, that deferred demand coming into 2021 on top of 2021 demand. The other thing is that there is the energy transition taking place. So it's a green energy transition, very base metals, commodities intensive. And the third thing also to mention, which was very important for commodities, was that the surge in demand for goods, generally speaking, has created an energy crunch. And as companies were trying to ramp up output to meet that surge in demand, and basically that energy crunch led, for instance, to a curtailment in aluminium production. China, for instance, 6% of its energy consumption is aluminium smelters. So they had to curtail demand of, aluminium output to be able just to feed up the more interesting parts of the economy, because aluminium is just a very small percentage of the economy. And keep that thought, because it'll be very important in the conversation we're going to have on gas and energy in Europe. So as I mentioned, very tight markets in backwardation and the transition. And then next happens is the war, is the Ukraine-Russia war. So the immediate concern for the market at the time was, are we going to go into sanctions? Are we going to go into weaponization? And basically, first of all, the sanctions, I think after the 2018 sanctions against Rizal, we probably realized that sanctions, when it comes from the West on commodity producing countries, really backfires, because we're such intensive commodity users that don't really produce much in terms of commodities, that I think we were holding off on sanctions. The only sanctions that we've seen so far have been from the US on Russian oil and gas, but then it's easy to put sanctions on something you don't really import. And also the UK. So the second thing also is weaponization. Does Russia stop exporting some of its material? And that can be very, very painful. The problem with weaponization, and that's something we saw in 2010 when China put an export ban basically on rare earth metals to Japan, on the back of the conflict on some islands, is that you lose the trust of that client. So basically what happened is that Japan used to import 90% of its rare earth metals from China. That dropped to 58%, and now it's probably in 2 years' time, 50% of its rare earth metals only is going to come from China. So you lose your long-term clients. So what are we seeing now? What we have seen is neither weaponization nor sanctions so far, but more of self-sanctions, meaning more of boycotts. And in terms of the self-sanctions, we've seen the biggest impact has come from banks refusing to emit credit letters. So that has completely frozen a lot of the commodities market. We've seen Lloyd's Insurance refusing to reinsure the aerospace industry in Russia. So it got a big impact on the airline industry there. Maersk refusing to ship to and from Russia. Dockyard workers refusing to lift Russian oil in the UK, and the list goes on and on and on. So the big question here has been, does China become the market of last resort for Russian commodities? So far, the Chinese banks have been very hesitant in jumping in. As a matter of fact, a lot of them have restricted financing for Russian commodities. On the other hand, China and Russia are getting closer. We saw that during the Olympic Games with the deal they had signed together. And also China, interestingly, has passed a law last year which forbids Chinese companies from complying with US extraterritorial sanctions. So it's also interesting to note that China has declared interest in Russian companies. So now they've jumped in and suggesting that they'd be interested in having a stake in Gazprom and having a stake in Rusal. So Chinese interest is there, but as it currently stands, as of today, the financing from China isn't really here. Now, I think looking at oil, it's interesting to know that when the exposure of Russia and of Europe on oil. So Russia exports 50% of its exports basically go to Europe. So we're talking here about total Russian exports being 5 million barrels a day, so probably 2.5 million barrels a day towards Europe. So no one wants to lift at the moment Russian oil. There's a reputational risk. There's the insurance. Getting insurance is complicated. So who's going to take that oil? Well, at least oil, unlike gas, is relatively fungible. Ural, which is an oil grade, Russian oil grade, is currently trading at a $19 discount, but that's still not attractive enough to Asian buyers. And also, we shouldn't forget that not all refineries, especially a lot of the Asian ones, are set up to accept and to process Russian crude. So it's easier said than done. These things take time. They have to think really deeply if they want to accept the Russian crude. And also, is there really appetite for anyone to issue credit letters to the Russian companies? So eventually, we can see rerouting, but that's not really happening at the time being. So how can Europe replace the Russian oil? So we've seen the US really trying to push for the Iran deal. The problem with the Iran deal and the oil they have is that the Russians have to sign the nuclear deal too, and that doesn't look very likely. Venezuela, we saw the US sending a delegation to Venezuela to negotiate. That's hard to find, hard to see that they're going to accept. There's also MBS. Apparently, he hasn't been answering the phone calls from Biden. So what is the solution here? Well, there's still OPEC capacity. There's still 1.7 million barrels a day within the deal. Plus, you reach probably 2.5 million barrels a day, which is equal to what the Europeans need, if you add up the additional supply that the UAE and Saudi Arabia can get. So that could cover European demand. The problem here is that by using this spare capacity, you're really stressing the market. You're making a very, very tight market here. The other thing that the Europeans could use, in theory, is the strategic petroleum reserves, which they have. But that's a little bit like the central bank selling its gold. You don't really want to touch that because it's really sending the wrong signal in the market. So let's imagine Russia shuts in the oil. What do we get? I mean, on the right-hand chart here, just to make things easier, it's total SPR in the world. We could probably run 5.7 million barrels a day for a full year before we exhaust all the SPR. So that's really hypothetical. It's not really going to happen. But it's just this to show you how much there is out there. But even if we did use the SPRs, there is the story here is that there isn't enough slack in the market, even with the excess capacity, with the additional capacity that can come online to keep the market calm. So we would expect for oil prices to remain very elevated in terms of historic terms, but not necessarily at those levels. Now, moving on to, I think, the gas question of Europe, the European Union Commission on the 8th of March announced a plan to reduce gas imports, to reduce reliance on gas imports by 2/3 by the end of the year. And basically, it's based on 3 points. So it's increasing non-Russian gas supply, optimizing storage, and reducing demand for gas. So how can the EU increase non-Russian gas supply? And everyone's been talking about LNG. The problem with LNG is LNG output is 496 BCM in 2020. 300 of those go to Asia. They're very long-term contracts. It's not like they're all on spot and everyone can rush and buy them. They're bound by long-term contracts. And Northwest Europe is getting 95 BCM from Russia. So 95 BCM versus total capacity of almost 500. You see that's very unlikely that LNG is going to save the day. It might participate a little bit, but what we saw, the question is, how much LNG can Europe get in? Well, we have the answer because late last year, Europe maxed out the amount of LNG it can get in. And as we know, that wasn't enough because prices remained very, very elevated. And there's a lot of talk about regasification capacity in Europe. Yes, it's true, there is regasification capacity that's mainly concentrated in Spain, which isn't really connected to TTF. So the final problem with the idea of setting a target of how much gas we want is the weather. So unlike oil, you can kind of predict how much oil demand is going to be during that month. But with gas, as that chart number 10 shows, you can get a huge swing during the same week on a different year. So we're talking about 1,000 MCM per day versus 2,000 MCM per day. So if next year we get a horrible, very hard winter, it's going to be a very, very difficult situation. So what do we do? Yes, we can get all the LNG, but we're going to be capped. Energy curtailment is probably something that's going to take place. It's probably maybe of inefficient GDP, value-added industries like the China story I was mentioning earlier on. One thing that needs a lot of political will, but could be a solution, is firing up again the Netherlands Groningen field. It's probably got a capacity of 100 BCM. Europe needs 95 BCM. So there are some solutions there, but frankly speaking, the most realistic one is basically reducing consumption. In terms of metals, for the little time I still have, is that looking at aluminium, it's going to be tight. Basically, Rusal has stopped its aluminum operation in Ukraine. That operation is equal to around 900,000 tons of aluminium. Second problem Rusal right now has is that Rio Tinto is refusing to ship bauxite to the Rusal operation in Ireland. So that's another equivalent 900,000 tons of aluminium. So it's very tricky for Rusal and the Russians because they're reliant on the other part of the commodity, which is bauxite. So from all the commodities, which one could Russia really weaponize or use against the West? The best candidates probably would be palladium and titanium. You can see the exposure of Europe here is very high also on nickel. So nickel imports from Russia are very, very high. Russia produces 25% of nickel grade 1, which is the nickel that goes into the cars, but just 8% of the normal nickel. But aside from the nickel story, as I was mentioning, probably palladium, because Russia produces 40% of the world's palladium, but as a percentage of its GDP, it's only 0.4% contribution to its GDP. titanium, they produce something like 30% of the world's titanium, and again, it's tiny compared to its GDP. But the impact on whoever is buying the GDP, because the palladium or the titanium, is going to be very big. It's the auto industries, it's the high-tech industries, it's the aerospace industries that are value-added industries which cannot operate without those metals. So it's a little cost for Russia at a big expense for the West. So all in all, to conclude, I think in the near term, commodity prices remain elevated, even if even if, let's say, Ukraine wins or Russia wins or the war ends in Russia and Ukraine, commodity prices will remain elevated as Europe actively seeks other sources of energy and metals. It's going to put on overdrive the energy transition in the long term. In the short term, we're probably going to be seeing maybe coal being used in Europe, so probably some pollution in the near term, but definitely an acceleration of European independence when it comes to energy. The rapport Varin came out not long ago. It's probably going to fast track whatever will that was in it in terms of independence from Russia. So the other thing also worth mentioning is probably the increasing role of Beijing and rapprochement with Russia. Do we get two worlds competing with each other? Because when you think about it, Russia, China alliance, probably African country alliance also, that's a lot of commodities. That's most commodities in the world. So we expect pain for at least 2 to 3 years when it comes to energy prices. And again, it's LNG, gas is the hardest to replace. Oil is more fungible. Metals is the most fungible. That's about it from my side, Patrick. I don't know what your thoughts are on the situation and what insight you can give us.
Thank you, Bernard. Of course, I will start from your assumptions and conclusions on different commodity prices and of course, on the risk that we might face very severe shortages for a number of commodities. So I want to make a couple of points on the economies and on monetary policies, I said before, and on the capital market. So actually have 7 points to make, but don't be worried, it won't be that long. So I will start with inflation. And as Bernard just told us, I mean, the increase in inflation dates back to the COVID crisis. And this is very important to realize, and this chart shows exactly this, but we had a tremendous shift in the composition of demand. You see the top line is demand for goods, the bottom line is the demand for services in the OECD, and you see that there's a major shift from services to goods. And this is the first explanation Bernard mentioned on higher commodity prices. Of course, if you need to produce more goods, you use more energy, more metals, more transportation, more semiconductors whatsoever. So, of course, the second shock is the war in Ukraine. And then, as Bernard just reminded us, Russia accounts for a very big share of the world production in very sensitive commodities, metals, gas, oil, and of course, cereals as well. And so, of course, since there is a risk that actually or in the future or presently already we may face the fact that Russia would export less of these commodities. This has been, of course, adding to the increase in commodity prices. So what I will use as expectations for commodity prices is probably close to what we have today. I think today we have Brent prices around 112, 13. We have the TTF in Rotterdam, which is like 115 as well. So basically my expectations in terms of inflation and wages and wage developments are based on prices which are close to what we have today. But of course, the level of uncertainty is very large. So the first effect of all of this, of course, is higher inflation. So when you calculate where inflation might likely go to in the next few months, this is US inflation. So it might end up in 1 or 2 months by going to around 8.5% at least. And if you look at Eurozone inflation, The last point, as you know, is just below 6%. It might go to about 8% or even slightly more than 8%. So we'll end up with both in the US and Europe with inflation around 8%, which is or above 8% in the US, which is very impressive. Just to remind you that the cause for higher inflation in the US is not only commodity prices. There is a very special cause, which is very important to realize, which is the very big increase in profit margins by US corporates. If you look at the top line here, this is showing profit margins. Technically, it's the ratio of prices to cost, and you see this big increase, which is adding 3 points to US inflation. Which is a massive shock to inflation. You don't have that in Europe. As you see in Europe, at the bottom, profit margins are about the same as before COVID. So that's my point number one. We will be heading to a level of inflation which is at least 8%, both in the US and Europe, but we probably will still be a bit higher in the US. Now, the second point in this to look at this macroeconomic environment is to look at real wages. And a lot of people are commenting the similarities between today and the 1960s, 70s, 80s. You find a lot of people telling, well, we're back to the 70s, 80s. It's a Cold War. We have higher commodity prices, more inflation. The need, I'll be back to that, of more public spending. But there is a very important difference if you look at the economies between the 70s, 80s, and today, which is that today, nominal wages are very, very little indexed to inflation. So here you've got nominal wage developments. This year in the US, we expect wage growth to be around 5%. You see, before the crisis, it was like 3, so you've got 2 points of additional wage growth, where you've got 6 points of additional inflation. And in Europe, we expect wage growth this year to be around 2.5. It was like 1.5, 2 before this war. So you've got like 1 point additional wage growth in Europe, whereas inflation has increased by 6, 7 points. So the degree of wage indexation to prices is very low. And for the economic environment, I mean, really for the economies we live in, this is very important, because it means that real wages will diminish tremendously. You should expect real wages to diminish by about 3 to 4% in the US and by about 5 to 6% in Europe, which is incredible. I mean, as a drop in real incomes. And it means also that the burden of this crisis is borne mostly by wage earners. Those who suffer are wage earners and not corporates, because wages increase much less than prices. And actually, we should not expect, and you see real profits in real terms here, we should not expect profits to be very much affected by this crisis. So most of the burden will be shifted to wage earners and to the households. Now, of course, when you do a scenario, and I'll do that in a minute, what you would need to know is which share of the decrease in real wages will be offset by more public spending, by the governments, I mean, supporting the incomes of individuals the way they did during COVID. We still don't know. This is still being debated inside the governments. So I've been doing a rough assumption that half of the decrease in real wages would be corrected by more public spending and more budget deficits, but we don't know. But most of the finance ministers in the OECD have told that they would not react as strongly as during COVID. It would be a more targeted and limited reaction. So my point number 3 is to just look at what all of this means. So we have seen that all of this means much higher inflation. What does all of this mean for growth? Of course, as I said just a second ago, real wages are already collapsing. So if you, even though, of course, this will be smoothed by the reaction of fiscal policies, but still, so we have a very substantial reduction in real wages, which, of course, will have a very negative effect on consumer spending. In the US, you've got an additional negative factor, which is the big reduction in budget deficits, which you see here. And if you look at the structural deficit, which is a better indicator because it's corrected for the cycle, you see that in Europe, basically, before the war in Ukraine, the fiscal policy was expected to be about neutral this year, and that it was extremely tighter in the US. So this is also contributing to slower US growth. You've got all the shortages Bernard mentioned, and on metals, and this is affecting the car industry, the aerospace industry, the IT industry, the tire industry, we realize needs some carbon imported from Russia. And it's very hard to measure that, but we are just seeing these days as the car industry seems really to suffer, and a number of plants will be closed in the next few days. So I will try in a minute to calculate with you what is the worst case scenario for growth in Europe. But it's clear that there is a big correction to the forecast we were doing, like everyone was doing 2 months ago. Of course, the correction is much larger in the US than in Europe because of what I will mention in a minute, which is the exposure of Europe to energy coming from Russia. But still, even in the US, we have to correct downwards our growth assumptions, and we have to do that very, very much in Europe. But I will do with you in a minute the calculation of this worst-case scenario in terms of Eurozone growth. But point number 4, I'll be very rapid because this is very well known, is that there is a need for higher public spending, not in the US, because in the US, as you know, the president has found it very complicated to pass more spending through Congress. But in Europe, there will be more military spending, and it's starting. The Germans have decided 100 billion euros of additional military spending. There is more spending on the energy industry to reduce the dependence to imports. Very likely, I mean, the programs to develop renewables and even nuclear energy will be accelerated. There is a big support for the households that will be decided in many countries. And I said before, it's a bit early to know by how much this support will correct the drop in real incomes. And of course, already after COVID, the governments were spending more on healthcare, on relocating manufacturing, on research. So very likely, Europe will run a budget deficit this year well above what was expected, which means that the new fiscal rules in Europe will be postponed by X years. And X might be a very large figure, by the way, so we even don't know if fiscal rules will be reactivated in Europe in the near future. I will use that in a second when I assess monetary policies. A word on the worst-case scenario for Europe. When you look at the forecast for Eurozone growth this year, which has been released by our colleagues in the rest of the banks, by the ECB, by a number of institutions, got an incredibly wide range. Basically, the range of forecast is between -1% to +3% for this year. So what should we think? Now, it's interesting to start from the worst-case scenario. So worst-case scenario is a scenario where we have seen by how much real wages diminish. At the peak of inflation, the real wages in Europe will be down 5% year over year, which is enormous. But a part of that will be corrected by more public spending. So let's assume that half of that is corrected. Then we have a number of energy imports from Russia which disappear. Bernard already mentioned that no one dared really take oil out of Russia. And this is explaining the premium now on Russian oil. Natural gas, so far, there is no shortage. We still receive the normal amount of natural gas from Russia, but what about the future? So if you assume that we stop completely importing any energy from Russia, then Europe will lose 17% of its energy resources. So I looked at what happened in Japan after Fukushima. After Fukushima, the Japanese succeeded in reducing their energy consumption by 10% compared to GDP in few weeks, actually. It was very impressive. So we Europeans are not Japanese, but suppose we do the same. So even if we were to reduce our energy consumption by 10%, if we lose 16% of your energy, you are still left with a 6% decline in GDP. So it can be absolutely horrible. I mean, so overall, the worst case scenario, and then of course you've got the loss in production for the car industry, for the airplane industry I mentioned before. So overall, the maximum loss in GDP you can assume for this year, if everything goes wrong, is around 5 points of GDP. So instead of having +4, indeed, we would have -1. But this is not what will happen, because we won't stop energy importing gas from Russia, because the budget will react to the loss in real wages. So I think that the best assessment you can have these days is that maybe Eurozone growth will be around 2% and not 4. So we will lose 2 points of GDP, which means that GDP, taking into account the base effect, will be about flat. So let me finish with central banks and asset prices. And here, of course, if you look at central banks, the Federal Reserve and the ECB are in a completely different position. Federal Reserve, the US are very little affected. They pay their oil a bit at higher prices, but that's it. There is no direct, spillover effect from Ukraine to the US economy. Europe is very different. I just mentioned that in the worst case scenario, we might be in a recession this year instead of growing by 4. So I call that a war economy in Europe. What is a war economy? Yeah, it's like it during World War II. We have the need for the governments to spend much more, so much more public spending, much wider budget deficits, shortages, higher inflation. So that's a very big stagflation. And how does a central bank react in a war economy? In a war economy, a central bank stops reacting to inflation. It completely abandons the objective of stabilizing prices, and its role in a war as a central bank is to help the governments finance very large public spending. So we know that whatever the ECB has been telling yesterday, but at the end of the day, if this war continues, if it's a long period of very big tension with Russia, the ECB will have to move to this war-based monetary policy where they will have to facilitate the financing of the governments, and they will have to keep very low rates and to keep buying on the bond market and not stopping their asset purchases the way they mentioned yesterday. But if you look at the forecast of the ECB published release yesterday, they are still very much too optimistic on the European economy. Now, of course, another issue, of course, for the ECB is what's going on with peripheral countries, and especially what you see here is the spread between BTPs and German government bonds. It's 165 BPs today, and Italy is very, very, very massively affected by this crisis because Italy is a country with a bigger exposure to Russian oil and gas. It's even more than Germany. And so Italy will suffer a lot. It's already visible. And so the ECB also will face the necessity of stabilizing the spread of Italy versus the rest of the Eurozone. So at the end of the day, I think it's sure that monetary policies will be more expansionary than when we were expecting. It's sure that long-term rates will be below what we were expecting. And it's sure that the ECB has not fully integrated in its comments yesterday what will very likely happen to the European economy. So they will have to be more expansionary than what they suggest yesterday. But of course, they have to be gradual. They cannot change their scenarios and their views in just 1 week. But as time goes, you will see that the ECB moves towards this wartime monetary policy. Just a word on that, and I still have 2 minutes. In this type of economy, where the governments have to spend a lot, where inflation is higher, where got a lot of shortages on many commodities, then what's very interesting is that what you see is an inversion of the roles of monetary policy and fiscal policy. We are just out of a world where monetary policy was in charge, was taking care of stabilizing prices, and fiscal policy was financing the necessary investments. In wartime, basically, just the opposite. Monetary policy just is the one which makes it that the government can finance their necessary spending. And if there is too high inflation, it's corrected by fiscal policy, by tax policy, by increasing taxes. So it's not monetary policy which is in charge of stabilizing prices anymore. It's taxes, and it's fiscal policy. And I think we will see this inversion of the roles of the two policies. So for me, one of the victims of this war is inflation targeting. I think that inflation targeting is over. Finally, what about asset prices? Well, of course, if you got central banks pursuing more expansionary policies and very high inflation, you end up with incredibly negative real rates. Look at real long-term rates in the US or in the euro area. It's completely crazy. And this will continue. We will have incredibly negative real long-term rates. And we will have, as I said before, decent profits because companies basically are shifting, corporates are shifting the burden of the crisis to wage earners. So what does it mean? It means that, of course, investors will, of course, in the very, very short term, where most of the reaction of investors was driven by risk aversion. Got a war, so risk aversion jumps, and people rush to very safe assets like government bonds. But after a while, they will have to protect against inflation, and they cannot, of course, they will have to exit the bond market with these crazy negative returns. So I think as soon as there will be an improvement in the geopolitical situation, or the hope of an improvement, we'll see a big recovery in equity prices. We have seen that in the last few days happening already. We'll see a very, very big demand for real assets, which means property, it means green, it means infrastructures, it means private equity, because what investors will have to devise is how to protect against inflation in this environment of incredibly negative rates. And the last thing, which is a bit more of a concern, is that we see a number of investors reneging basically on their ESG commitments. And this is, of course, there's a question of military equipment. Can you afford not to support this, not to finance these companies, especially in Europe or in the US, that will supply the necessary military equipment if you want to rebuild the European army, for instance? So I think the status of military equipment probably in the asset allocation investors will change. It will be something that will be less forbidden than what it was before. And also you see, of course, in a medium-term perspective, there will be an acceleration of the investment in renewables. But in a short-term perspective, we see more investments in fossils, in coal, in US shale, even in oil sands in Canada restarting. So, of course, the short-term shock is to try to basically to get rid of fossil imports from Russia, and then you need to redevelop fossil in the rest of the world, which, of course, goes in the wrong direction in terms of climate change. Of course, the medium-term reaction will be to accelerate the transition to renewables. So I stop there. So really the message, again, is that this is a different economy. It's not in the US. In the US, the change is marginal compared to what we had last month. But in Europe, it's not a marginal change. We are moving to an economy which is in a strong recovery, to a wartime economy, where you need to have much more public spending, you have higher inflation, got shortages, growth will be lower because of these shortages and high inflation. And the role of the central bank in this type of wartime economy becomes very, very, very different. So VCB is still in an intermediate position, but again, as time goes, they will have to realize that in this type of economy, their role is to support the governments and not to fight again commodity price inflation. Thank you very much, and I think Bernard is in the process of collecting your questions, and don't hesitate asking questions if you have any. Thank you very much.
Thank you for this, Patrick. I have a question here, is basically how sensitive is household income to commodities?
Well, if you look at Europe, I mean, energy represents 7% of households' consumption. So if you got, but this ends up with the same calculation I did on real wages in a different way. So if energy prices are up, which is about the case today, 50%, then this is reducing the purchasing power of the household by 3.5%. But it's not only energy, we have also food prices, which are above 4% year over year, and which also are a drag on households' income. So I would say it's a rough calculation because, of course, the prices change every hour. But I mean, so for today, the cost for households is about a 4-point loss in purchasing power before, as I already mentioned, before the reaction of fiscal policy. As there will be a big reaction, a big support coming from fiscal policies.
Yeah, and if I remember correctly, you had mentioned that the lower four quartile, I think, of household income.
Yeah, the lower the people in the lower quintile, I think, quintile of income, before COVID, spent 15% of their income on energy, and today it's 30%. And since the same people spend 40% of their income on housing, so housing plus energy now represents 70% of their income.
Without food,
which is absolutely impossible and which means that the governments will have to do something. So that we know that there will be checks to the households and energy checks and inflation checks and whatever.
I have another question here, which is, will Germany reverse its decision to close its nuclear power plants? From last I checked, I think the German environment minister, I mean, they still have 3 power plants, and the German environment minister had mentioned that they could extend they can extend the life if needed, but apparently it wouldn't be operational for next winter because the advanced stage of the shutdown.
But 2 days ago they announced that they would shut down these 3 plants and that they would use coal instead. So
right, okay. I mean, hypothetically, according to him, they could extend it in theory, but it's such an advanced state of shutting it down that even with all the will in the world, they couldn't operate it for next year.
But I mean, certainly Germany and Italy are in a much worse position than countries like France or Spain. Spain has, as you know, a lot of renewables, and France has this nuclear source for energy. So when you look at the share of energy imported from Russia, I mean, in France, it's only 2% of total energy. You know, that's natural gas. So Russian natural gas accounts for a bit less than 2% of total energy in France, whereas it's 10% in Germany, for instance. So of course, and Spain, it's even less than France. So Italy and Germany are in a completely different situation compared to France and Spain.
And then there's a question here asking, does the ECB mandate allow for a war monetary policy?
Answer is no. Answer is no, but I mean, the mandate was not written in this environment. No, of course, if this war stops in a few weeks and there is a diplomatic solution to that in a few weeks, what I'm telling about the ECB will get wrong. But when you speak to the diplomats and when you listen to President Macron this morning, I mean, telling that he was very pessimistic about a rapid solution, I mean, to the war in Ukraine. If this lasts, we will actually move to this wartime economy where the governments will spend a lot more, where inflation will be very high, and the need to keep low rates will be extremely strong because the governments will have to finance, I mean, this extra spending. Of course, it may be the case, and this is, you know, what the French are pushing, that Europe steps in and has a new program. It's very complicated for Europe to have a program whereby they support the households in buying their energy. This is really up to the local governments. And as I said before, the different countries are so different in this respect that it's very complicated to do that at European level. But it would make sense that Europe finances the increase in military spending, for instance, through Europe.
And another question for you also. What is your view on the extent of differentiation in capital markets impact in Europe, US, and Asia, respectively?
Yeah, I think I didn't mention that. I should. I mean, of course, this crisis makes winners and losers. The US are, I would say it's neutral for the US. The US consumer pays more for his gasoline, but the US are a big oil and gas and metal producer. It's very good for countries like Canada, Latin America. Think of metals in Chile or Brazil, Argentina with food products, Peru, Colombia with metal. It's very good for a number of countries in Southeast Asia, like Vietnam, like Australia, of course, in the Pacific, Malaysia, New Guinea. It's very good for Africa overall, oil, metals, food products. It's very good for the Middle East. And it's bad for Western Europe, it's bad for Turkey, it's bad for India, it's bad for China, which is a big energy and metal importer and food importer.
Probably for Russia too.
It's bad, of course it's bad for Russia, but in normal times it is very good for Russia. But so the biggest loser is probably Turkey. because they were already in a very complicated situation, and they are a very big importer of energy.
Okay, no, that's a bit not that question. How about the public deficit? Up to which level can it grow?
Again, I spoke yesterday to the French government, for instance, and they still don't know how they will react. So in Europe as a whole, we were supposed to have a 4% of GDP budget deficit this year. This is, or I check. It's around 4%. I will show you the charts. This is here. So you see in Europe, it was, the blue line, it was just below, it was assumed to be just below 4%. I think if you look at what the households will lose and the probable reaction of the governments plus additional public spending, the Germans mentioned that they would spend in 3 years 100 billion euros more on military spending. You might end up with a budget deficit perhaps around 6% of GDP this year in Europe, which would be about the same as last year, as you see on the chart.
Okay, and I've got a few questions here. Should we expect a wave, I'm translating from French, should we expect a wave of nationalizations? And also from La Tribune, which sectors are the most exposed in Europe and in France? Similar also to a question which is asking which sectors in Europe would benefit the most. So which sectors are the biggest losers, which sectors are the biggest winners, and can we expect a wave of nationalization just in Europe? Or that was one of the questions.
I don't know. There will be a wave of nationalization in Russia probably, but
okay.
No, in Europe we know. Bernard mentioned the losers already. This is all the industries facing very sizable shortages.
Yeah, I can think of the automobile industry as being
course.
A big loser in.
Yes.
First of all, for the ICEs, you've got generally the commodity prices rising for metal, steel, aluminium, etc., and oil prices rising. There's negative correlation between both. And for the EVs, even worse. I mean, you've got nickel prices going through the roof. They're much more sensitive to commodity prices. And on top of that, electricity prices in Europe will be surreal. So I think it's going to be a very hard time for the auto industry in Europe.
And of course, you got all the companies with a direct exposure to Russia, which includes the banks, which include agro-food, which includes a number of retailers.
Question here, I did not hear on asset prices. Shall we expect a further correction of equity valuation and specifically PE valuations?
Well, I think normally, again, you will go to unprecedented negative real rates, which is very good for PE ratios. So normally, PE ratios should keep moving up. And as I said before, I don't expect profits, earnings to suffer a lot because since wages, well, take Europe or France, I mean, the wage negotiations for this year are over. So all the wage agreements in the different industries have been signed for the euro area, the same figure for France. Wages this year will increase by 2.5%. So you may have a number of exceptional bonuses or here and there, but overall wages will increase by 2.5. So whatever prices do, companies will raise their prices, and so profit margins might even move up this year. I mean, so it will be very bizarre.
That's a question I wanted to ask you because you had mentioned about wages and profit margins in your presentation. I mean, can we see higher corporate taxes to be able to finance, you know?
There is a debate. A number of people are pushing for the governments to have some form of exceptional tax on these companies benefiting basically from the war, which would be mostly oil and gas companies, by the way. It's very complicated because, as you know, oil and gas companies state and their profits and pay their taxes in the countries where they produce oil and gas, not in the countries of their headquarters. So if you want to tax BP reports no profits in the UK, profits are in the US, in Africa, everywhere. So I think it's very complicated to do that.
Fair point. How to assess the real estate asset, well, I guess the real estate market value, future changes, considering on the one hand the household purchasing power reduction and on the other hand the negative real rates?
I think very Again, all of this is very rapid, so we can just try to put forward a couple of ideas. So what seems normal is that individual buyers would be more prudent, but institutional buyers would be very aggressive because they have to protect against inflation and they have to accelerate the shift of their portfolios to real assets. So probably we'll see that. We'll see individuals buying less, but professional investors buying more.
Okay. Lots of questions for you, Patrick, still. French question here from France. Mr. Artus, you wrote a book called France Without Its Manufacturing, Sans ses usines, on deindustrialization. Do you think that France and Europe are going to reindustrialize in the medium term within this context?
Well, they will try to, obviously, but this is not a consequence of the war in Ukraine. It's more a consequence of COVID, actually. But as you know, and read my latest book on this, if you can find it, it's everywhere. The big problem, as you know, is competencies. It's hiring difficulties. It's very hard for manufacturing to recruit in France because there's a lack of the corresponding competencies. As you know, only 20% of the young French graduate in sciences, and it's 45% of the young Germans. So there's a real shortage for people with an education corresponding to the needs of manufacturing.
Another question here for you, maybe more England-centric. Impact on Bank of England rates policy.
It's for you, Bernard. You're almost English.
It used to be. No, I'm joking. No, I can't really see it.
But I think I would say the same
as yeah. I don't see this any difference with Europe. A bond default by Russia is expected imminently. What are the likely repercussions? And I think I can tie up that question with another question in French. What is the impact on today, as of today, of the war in Ukraine on the French banks? So are they two related questions?
The French banks is public. You have seen the numbers being very transparently reported of the exposures to Ukraine and Russia. So you know the data has been published everywhere, so you can find it very easily. So it's let's say in some cases it's big, but manageable. I would say that. As you know, the bigger exposure is Société Générale, of course, which has a very big bank in Russia, Rosebank. No, I think well, the first part of the question. I think
so the first part of the question, which I published, just bear with me, was a bond default by Russia is expected imminently. What are the likely repercussions?
I think, yeah, but I mean, it's certainly the problem is not only the government of Russia. Certainly, the government will default, but you know the problem is because of the sanctions on the central bank of Russia. That if that any borrower any Russian borrower with a debt in Western currencies cannot service his debt anymore because normally the borrower was just bringing rubles to the central bank and taking the dollars or the euros or whatever, the sterling, and servicing its debt in Western currencies. Now the borrower cannot do that anymore. So what we start seeing is a number of Russian borrowers proposing to service in rubles their debt and not in Western currencies because they lost the access to Western currencies. But again, if you're a Western European investor, I'm not sure you want to be paid in rubles. I mean,
on that point, actually, there's another question here: is do you expect the yuan to play a bigger role?
I mean, the yuan today it represents 2.5% of world reserves, but it's 15% of the reserves of the central bank of Russia. So the global figure is biased because most of that is Russia actually. Russia after the war in Crimea, Russia moved its reserves out of the dollar and into the RMB. So this is explaining the increase in the share of the RMB. But apart from Russia, very few countries have reserves in yuan, in RMB. So as you know, the problem is that it's not convertible. So a non-convertible currency can be very difficult for it to be a reserve currency. And also there is a lack of financial assets to invest in. So I think Russia will probably, I just wrote that Russia would become a subsidiary of China. And you mentioned that as well, Bernard. That,
yeah, I mean they're already stating their will to buy into Gazprom. You know, the golden goose, if you want to call it. It's quite something to go and. It's quite cheeky, I find, actually, to go and say we're going to buy a stake in Gazprom or in Rusal up to that extent.
But then you will see Russia depend on China for both imports and exports, basically.
Yeah. Also, I think about gas
as well. Like China will choose the prices.
Yeah, and also I think about gas. You know, if Europe is completely ignoring Russian gas and Russia doesn't really have liquefaction facilities, they will be very motivated to build the pipeline towards China and having China as a reliable partner. But then, as you say, you know, you're putting yourself as being dominated by China.
China will become a monopsonist. I mean, they will have a monopoly power in buying Russian goods, which is very, very bad for Russia.
What will be the impact of the crisis on the euro-dollar exchange rate in the short and medium term? We got two identical questions on that.
Yeah, well, I mean, what I have to say is very, very simple. Well, it's very simple, and it seems obvious. Now, there will be a major asymmetry. There was already a major asymmetry between the Federal Reserve and the ECB, which was based on wage developments. As you know, labor supply in the US has been decreasing by 2% since COVID, and in Europe it's above the pre-COVID level. And this has led to, of course, to wages increasing much faster in the US than in Europe. This year it's 5% in the US, 2.5% in Europe. And this asymmetry, which is coming from the labor market, of course, has a big effect on monetary policies. And this was already priced in, basically. Now we have a further, of course, asymmetry due to this war, which is that growth in Europe will suffer much more than growth in the US. So I expect the euro to, well, euro already weakened a lot, but I expect the euro to weaken even more. But yesterday, the ECB, I said before, did not fully react. I expect the ECB to change its communication as time goes towards becoming more dovish, and then very likely at that time the euro will depreciate more.
I think we have time for one last question. Yeah. It's a good question, I find, at least, is how do we manage the social crisis that might arise from inflation and its impact on household purchasing power?
Well, I think what the governments everywhere in Europe are trying to assess is trying to decide about how they react. Of course, remember 2020. I mean, overall in Europe, real households' income increased by 0.6% when GDP was down 8%. But the governments don't want to repeat that. I mean, to take all of the burden on the budget. So I think there will be something more targeted, as I said before, to the poorest people. I mean, so probably a big government transfer to the poorest Europeans, but not to everyone the way it was done in 2020.
Excellent. I think that's about it. We are 1 minute away. Thank you a lot, Patrick. That was most pleasant.
Thank you, Bernard, for insights on commodities, which were very helpful.
With pleasure, with pleasure. Thank you.
Thank you very much, all of you. And don't hesitate mailing us questions if you've got remorses, if you want to discuss more. So you know where we are, and have a nice evening or end of afternoon. Thank you very much.
Thank you.